Hi, welcome back to another edition of Flipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining us today. I'm going to be reporting flows for the week ended July 3rd, 2013. That's Wednesday to Wednesday period. And if we take a look at the overall flows, we see that the conventional fund business, and again, this is excluding ETFs, although we will talk about ETFs later on, had about $5.3 billion net new money added to their coffers. And this is despite hearing about the tragedies in Egypt, Portugal actually having a failure of their government once again, and also weakening economic growth in China. It's just been an ongoing story. And in fact, what we've done is we've actually taken a look at some of the good news that has been coming out, and that's, I think, what's been driving most of the market as far as at least equity funds. And we've seen some strong economic reports. We saw that the June ISM number, manufacturing number, came in above 50. It was like 50.3. But again, it was expansionary, and if you remember last month, it was actually in the 49 area, so we were looking at a contraction in the market. And then we also had some good news on the European Purchasing Managers Index, also doing the best it has in quite some time. So that led us to a pretty strong week. Let's see how that shook out as far as flows goes. Let's go take a look at the macro groups. Equity funds saw about $3 billion in net new money coming to their coffers. Taxable bond funds saw, and not surprisingly, saw a little bit of outflow, $0.6 billion in outflows. Muni bond funds saw a little bit of a reprieve. Again, they saw money fly out the doors, and it's $0.8 billion, no small feat by any means. But again, it was one of those things that we've been seeing some big numbers, so it was a relief there. And money markets saw about $3.7 billion of net new money come into their coffers. So if we want to take a look on what's happening on a detailed focus, I think that'll give us a little bit better picture of what's going on. So let's take a look at equity funds. Equity funds actually saw a return. This is the second week in three that they've seen a positive return, 1.35%, and they saw about $3 billion in net new money come into their coffers. It's the 26th consecutive week we've seen net new money come into equity funds. And this is, again, despite some of the concerns that we've had, and actually kind of a ho-hum type of quarter end that we had as well. Kind of disappointing news. We've seen the market kind of tank a little bit. Some people are calling it the retracement that we needed. But nonetheless, we saw some money get lost in the markets, but we saw money continue to flow into equity funds. Year to date, though, we've seen about $108.4 billion net new money come into these coffers. And when we break it out, domestic equity funds saw about $1.1 billion of net new money. It's the fourth consecutive week that they've seen flows, and non-domestic equity funds saw $1.9 billion, fifth consecutive week that they've seen money come into their coffers. Now, we've been seeing a lot of people actually flee the large cap group, and actually investors gave a nod to large caps this week, about $0.6 billion net new money coming into their coffers. Now, on the flip side, where we wouldn't expect money to go, emerging market funds, is where we saw money go. About $1 billion of that 1.9 that I was telling you about went into emerging markets. So it does appear that investors are still looking for growth, or they're caught up in this trap where they're kind of chasing after what was hot. We'll have to see as the weeks and months go on over the next several months. And if we take a look now, and by the way, for emerging market funds, it's the fifth consecutive week that we've seen inflows. And again, this is in light of seeing weakening growth in China. We've been seeing again concerns in Egypt, and also, again, what I said before, we've seen Portugal, again, look like they're going to have a failed government just around the corner. So that's just some of the news that we've been hearing. Let's take a look at the equity ETFs, though. We had a little bit of a difference in there. We saw that their inflows for the second week in three, about $1.6 billion in net new money coming into that coffers. Financial services and other select out of favor, so interest rate type of interest rate sensitive stocks, and other high-risk areas took the money in. So again, we saw the financial select sector, SPDR, taking about $0.8 billion. We saw the iShare Russell 2000 taking about $600 million. We saw the iShares MSCI, again, emerging market, taking about $500 million. So this was kind of a change. But now if we take a look at the bottom, we saw that SPY, anything to do with SPDR, got crushed. And it wasn't really that big of an inflow, so I'm over-exaggerating a bit with crush, but $1.1 billion out of SPY itself. We saw the ProShares Ultra S&P 500 lose about $1.1 billion, and iShares Core S&P 500 lose about $700 million. So certainly people on the ETF side were not giving the nod as the open-end fund side did to the large cap group. Well, here's where we kind of diverge from what's been going on. We saw a kind of a tale of two cities in fixed income. Let's talk about the conventional fund business first. We saw that there was some concern with tapering. Everybody's been talking about the Fed tapering here. I think people have come to the conclusion that the Fed is going to eventually, over the next several months, get into its tapering program and get rid of some of that easy money. But what we've seen is for the 5th consecutive week, we've seen outflows, and there's about $600 million of outflows out of this group. And that's not a real large amount, but it's the second week in 3 that we've seen positive returns, so 0.68%. So people are a little bit confused on what they should be doing. Interesting enough, though, where we saw some of the flow patterns and the differences in flow patterns, we saw that Treasury and mortgage funds saw about $450 million in money exit their coffers, while loan participation funds, as we'd expect in a rising interest rate environment, took in about 0.8 or $800 million of net new money out of, from their coffers. And by the way, this is a 56th consecutive week that they've seen net new money come into their coffers. So this is an amazing feat as far as that goes. But here is the story of the tale of two cities that we were talking about a little bit earlier. And that's where we saw the ETF universe diverge. Basically, we saw people putting money back to work into treasuries. We saw in the ETF universe, the bond fund universe, taking about 3.9. That's no record. We saw that about 5 weeks ago as well, something in the $4 billion range. But where we saw a record, something we haven't seen since 2002, and that was when the first creation of the Treasury ETFs were made, $2.4 billion into Treasury General, if you will, mutual fund ETFs. And this was kind of an amazing feat because $2.4 billion, big chunk. Where we saw it was iShare 3 to 7 year Treasury, $2.2 billion. That was almost all of it. And it's kind of amazing. People are actually playing the kind of that belly area, 3 to 7 year belly. I think they're anticipating that with the auction coming in, we have a $66 billion auction coming up this week, that there's going to be some chance to make some quick money as we see interest rates go up and down very quickly with the concerns that we're seeing, again, in Portugal and in China and, last but not least in Egypt. So we saw that. Now the top 4 groups were actually in treasuries, as you take a look. And then if we look at the bottom, longer dated, international, and tip funds were the biggest losers out of the ETF universe. So now if we go ahead and move on to one of the more interesting areas of this of late, muni bond funds. They have just been getting crushed as of late, and in fact this is something that they continue to get crushed on. We saw for the first week and 9 plus side returns, 0.76% return, but the 6th consecutive week of outflows. About $800 million of money leave the coffers of this group, and again it significantly beat that 4-week moving average of $1.7 billion. So again, it is not as severe as it has been over the last several weeks, but certainly a bloodletting the same. And where we saw the big money come out was national munis. They saw about $700 million leave their coffers. When we're talking about places to hide and safety and the like, we are seeing some money flow into money market funds. And that's what we saw this week. $3.7 billion in net new money come into the money market fund coffers. 2nd consecutive week of inflows. And again, we think this is just because people are concerned. They don't know where to go. We're approaching the dog days of autumn and summer. And we just started summer. But certainly the concern is that we're going to just be in this kind of flat, lackluster summer. And a lot of people are trying to find places to park their money until the onslaught is over. As you know, in June we saw 15 triple-digit move days. When we first started July, that first week in July, and this is Wednesday to Wednesday, we saw that there was 3 triple-digit move days out of the 5. So it's just been kind of an amazing period of time where we've seen a lot of volatility, but the volatility continues. Well, if we break this down, taxable money markets saw about $1 billion of outflows, and of inflows. Interesting enough, we saw that institutional money market funds saw $2.9 billion out, and the taxable non-institutional monies, the regular retail money market funds, saw about $1.9 billion. So let me go back and correct that. So we saw about $1 billion in outflows out of taxable money market funds. But amazing, people that had tax-exempt accounts have putting money back to work rather than munis. They need a place to hide. They still want to be tax-exempt. They're putting in a tax-exempt muni money market funds. $4.7 billion net new money in that group. That's actually a large amount of money. Well, one of the things that we're going to keep our eye on as we come up today is Monday. We've had a couple of days off just because of the long holiday that we had from 4th of July. And, a lot of people took Thursday and Friday off, and we're finally getting back to work. But one of the things that we're all looking forward to is the earnings reports that have came out. We have Alcoa kicking off today, and that's going to be an important issue. And, of course, we're going to keep our eye on the economics. But we're really getting a little bit tired of the economics piece. Now we're going to look towards earnings, and I think that's going to help drive the rest of the month of July and certainly even a good portion of this quarter as we go forward. If you want to do a deeper dive, though, into the flows, you can go to our website, lipperusfundflows.com, or you can just join us next week where we can talk to you about the flows and what's going on by the next analyst that's going to cover this. And again, until next week, my name is Tom Rosine, wishing the best in your wealth planning and creation.